NIO stock closed sharply lower on Tuesday, falling 36 cents, or about 5.3%, to finish the day at $6.80 per share. The drop comes just one day after the stock's impressive 7% rally on Monday, a move that had given investors a small dose of optimism following weeks of macro-driven weakness. So what happened? What changed so quickly? And does this setback tell us that yesterday's rally was just a false dawn, or something deeper about the state of the market? Let's start with the big picture. Tuesday's weakness wasn't about any single company or sector. It was about tone. Markets were rattled once again by a renewed wave of sabre rattling between the United States and China. After Monday's hint of cooling tensions, when Donald Trump posted that the United States wants to work with China and avoid a depression, traders had hoped the worst of the rhetoric was behind us. But as the new trading session began, that brief calm evaporated. Statements from political figures, along with rumors of further tariff threats and retaliatory export measures, reignited investor anxiety. Suddenly, the same fear that had eased just 24 hours earlier was back on the table. When that happens, risk assets take the hit first, and few names are more exposed to shifts in trade war sentiment than NIO. As a Chinese electric vehicle maker listed on the New York Stock Exchange, it sits right at the intersection of global supply chains, technology policy, and investor psychology. That means even when NIO itself isn't doing anything wrong, the stock can become a casualty of macro tension. And that's exactly what we saw on Tuesday. But it wasn't just rhetoric. Global markets reflected the growing unease. Asian equities traded lower. European indices slipped. US futures spent much of the session in the red. There was a clear rotation out of risk and back into defensiveness. In that kind of environment, stocks that had bounced strongly the day before often become the first to sell off. NIO's 7% rally on Monday was fueled largely by relief, not by fundamental news, and when the mood turned sour again, those gains became vulnerable. Traders who bought the dip took the opportunity to lock in quick profits, and short sellers who had been caught off guard by Monday's surge likely reloaded their positions. From a technical standpoint, this kind of move isn't unusual. Monday's bounce took NIO back above the $7 level, a psychologically important marker that also aligns with short-term resistance on the chart. Once that level was tested and failed to hold, selling pressure intensified. The result was a swift slide back into the mid-sixes, erasing much of the prior day's progress. That's why, in high-volatility environments, technical zones like this matter so much. They're not just lines on a chart, they're thresholds for sentiment. When a stock can't hold above a key level after a strong rally, it signals that buyers aren't yet confident enough to sustain the momentum. Now, before we assume the worst, it's important to note that there was no negative NIO-specific news driving this drop. The company didn't announce any production issues, earnings revisions, or executive changes. In fact, the fundamentals remain the same as they were 24 hours earlier: strong delivery growth, ongoing infrastructure expansion, and improved liquidity after the recent capital raise. So this isn't a story of deteriorating company performance. It's a story of external forces and market psychology overpowering fundamentals in the short term. If anything, this reinforces just how sentiment-driven NIO trading has become. Investors are navigating a delicate balance between optimism about the company's execution and pessimism about global politics. That tug-of-war creates volatility on both sides. When fear eases, rallies are explosive. When it returns, pullbacks are just as fast. It's not about logic, it's about emotion, and the headlines that drive it. Looking beyond Tuesday's numbers, the renewed sabre rattling tells us that neither side in the trade standoff seems willing to step back yet. Reports from Beijing suggested new countermeasures could be considered if US tariffs expand further. Meanwhile, US officials reiterated that all options remain on the table. The tone remains confrontational, and markets hate uncertainty. Every new headline becomes a trigger for algorithmic reactions, and that's why we're seeing such exaggerated day-to-day swings. In calmer times, these kinds of statements might not have mattered as much. But in a nervous market environment, they land with disproportionate impact. So how should we interpret today's decline? There are two main ways to look at it. The first is that this was simply a correction of Monday's overreaction. After a big bounce driven mostly by sentiment, it's normal to see some give back. Traders who bought the rumor sell the reality. The second interpretation, and perhaps the more concerning one, is that the market's trust in yesterday's cooling narrative has evaporated. Investors might now see Trump's Truth Social post as just talk, rather than the start of an actual de-escalation. If that's the case, we could see sentiment sour further in the short term. There's also a technical point worth mentioning here. The fact that NIO fell back below $7 on volume suggests that Monday's rally might have been more short covering than genuine accumulation. When short-term traders rush to close bearish positions after a strong day, you get a surge of buying that can look like real strength, but once those positions are closed, the support disappears. That could explain why Tuesday's drop was so swift. With no follow-through buying to reinforce the move, gravity took over. However, that doesn't mean the bigger picture is broken. NIO still has the same strategic strengths it had before this week began. Its Q3 deliveries were up 41% year-over-year, at 87,071 vehicles. Its battery swap and fast-charging infrastructure remains unmatched among Chinese EV peers. And the recent capital raise, though unpopular with some investors, gives it the runway it needs to keep investing in innovation. The business is still doing what it needs to do. The problem isn't NIO's execution, it's the macro fog surrounding it. So, if you're framing this for a Tuesday aftermarket video, the key theme should be reversal, not ruin. The market's short-term trust in Monday's optimism faded under renewed political noise, and NIO, like most China-sensitive stocks, took the hit. But the fundamentals remain solid, and volatility like this is exactly what defines the current cycle. For viewers and investors, the most useful thing right now is to track a few specific signals over the next few days. First, watch whether NIO can stabilize above 660 to 670. That range has acted as support multiple times in the past month. If it holds again, that would suggest some underlying demand still exists. Second, monitor trading volume. If the selling volume from Tuesday continues to decline through Wednesday, that would indicate that the panic is subsiding. Third, keep an eye on other China-related equities. When names like XPeng, Li Auto, and BYD move in tandem, it's usually not about company-specific news, it's about macro sentiment. A collective stabilization across the sector would be a good sign. From a video narrative perspective, today's pullback could be framed as a reality check moment. Monday's relief rally gave investors a taste of what could happen if tensions truly ease. Tuesday reminded them how fragile that hope still is. That tension between optimism and realism is what's shaping the current price action. The macro environment is still the steering wheel here. Company fundamentals are just the engine waiting to accelerate once the driver stops swerving. If you're structuring this video for voiceover, here's how it might flow naturally. You open with, NIO stock gave back most of Monday's gains, closing at $6.80 per share after a 5% drop. The culprit? Renewed trade war rhetoric that quickly reversed yesterday's optimism. Then transition into, markets had celebrated Trump's post suggesting the US wants to work with China and avoid a depression, but those hopes didn't last long. Then build the body of the monologue around three key ideas. 1. The macro reversal. 2. Technical fragility. And 3. The underlying strength that remains intact. You close with a reflective tone, something like, NIO didn't suddenly become a weaker company today, it just got caught in the crossfire of renewed uncertainty. As for what happens next, the short-term direction will likely hinge on headlines, not data. Until we get official clarity, maybe a policy announcement, a meeting date, or a joint statement from trade officials, markets will keep reacting emotionally to every rumor and quote. That's the reality of trading in a politically charged environment. The key for investors is to avoid overreacting to the noise and instead look for patterns in the behavior of the stock itself. If NIO continues to find buyers in the 640 to 680 range, that tells you confidence still exists beneath the surface. Tuesday's 5% pullback, while disappointing, isn't catastrophic. It's part of a broader pattern of volatility that's likely to persist until the macro picture clears. If anything, this kind of price action reinforces the importance of patience and perspective. When the headlines are loudest, the best opportunities often belong to those who can stay quiet and think clearly. So as we head into Wednesday, the question isn't just whether NIO will bounce, it's whether the market can find a tone that lasts longer than 24 hours. If it can, then this drop may end up looking like a temporary shakeout rather than a trend reversal. But for now, volatility rules the day. And that's your NIO Tuesday update.